The Canadian banks look like they're increasingly under pressure as more and more fines are being handed out, and Canadians are less than $200 away from being bankrupt, as a new report has shown. So this has been circulating and essentially going viral on X. Half of Canadians $200 or less away from not being able to pay bills. And when you think about that, you have to obviously visualize what that means for the banks, because the banks are just five banks essentially. Obviously, it's a very monopolized part of the economy, the banking sector, and you've just got those five big banks, and they hold most of the loans, the credit card debt, and everything that is outstanding. So if this is the current situation, that means that obviously the risk of them getting into trouble is just skyrocketing right now, which we know is the case, and we've discussed many times on this channel. So let's get into it. The Bank of Canada's rapid interest rate cuts have seemingly not helped Canadians feel much better about their financial pictures, as MMP reports a new low in its outlook on personal debt. Now, obviously, we talked about this many times as well, that the interest rate cuts, are they really going to do anything? And you only have to look at consumer confidence to realize that that is not the case here. If you look at what's going on with consumer confidence, you can see here that it's pretty much trending lower. And if you actually pull this out to the 10-year, you can see it is actually pretty low. And if you max this out, you can see 2015, 2016 is about where we are, where we narrowly avoided a recession back then. So interesting. Canadians' personal debt outlook, a rating MMP calculates by asking where Canadians feel their financial health lands on a scale of excellent to poor, fell 12 percentage points, just 8 points in the most recent quarter. That figure normally floats in the mid-20s and has never been lower in the history of the debt index, which launched in 2017. So again, this is just showing you how desperate people are. But a lot of people look around and they kind of go, well, why isn't there carnage right now? Why isn't there blood in the streets? But the reality is it takes a while to actually get to that point. Even if people are defaulting, guess what? The banks are going to try and work with them for a period of time, because they don't want to take them to court and have thousands and thousands of court cases. That's why the cash for keys deal happened in 2008, which was actually funded by the US government, was to just get people out of the house and pay them a fixed fee, just so that it wasn't clogging up the court system, because there was already enough people in court over their debt. So MMP's latest findings rely on an Ipsos polling of more than 2,000 Canadian adults from December 6th to the 17th. That means the poll captured some sentiment following the Bank of Canada's most recent interest rate cut of 50 basis points on December the 11th, a move that brought the central bank's policy rate down to 3.25%. So despite what they're saying about the interest rate cuts every time they happen, that things are going to get better, that's not the case. And we'll get on to what's going on with the banks in a minute, because that's so interesting to see how they're all getting these fines levied against them, with obviously everything that's going on their balance sheet that we know of, like the deteriorating outlook of their consumers, which is really, really obvious here. So Grant Bazian, president of MMP, told Global News on Monday that rate cuts to date haven't changed the financial picture for many households. Rate cuts, like hikes, tend to have a lagged impact on Canada's economy. It can take a year or more before top-level changes in the cost of borrowing trickle down to Canadians' finances, economists say. And I would agree with that. It's mostly the case, and the way things work, it's not just going to suddenly happen that interest rate comes down and everybody's going to be better off, especially when you look at unemployment going up at the same time, because obviously that has a impact on the economy as well, especially when it comes to sentiment. And if you actually look in this article here, they actually highlight that. But it also says here that a third of respondents said they are insolvent, with a woman more likely to be $200 away or less from insolvency. Canadians are also feeling job anxiety, with 2 in 5 respondents worried someone in their household could lose their job. That figure is the highest that it's ever been in the history of the report. So again, that's not surprising, is it, considering what's going on with consumer confidence? But how does rate cuts actually affect that? It doesn't affect that. situation. And that's what the mainstream media fails to understand. But I think a lot of this is just kind of what the Bank of Canada wants to happen. They want the mainstream media to be saying, oh, this is going to be stimulative, rates are going to come down, the economy is going to rip higher. And they're just hoping that people actually think, oh, yeah, that's going to happen. And then they start to buy things and the economy improves, when of course it's not going to work like that. If the reality is totally something different, people are going to see straight through it and they'll see what's happening with their friends and their family. So the overall trend in Canada's unemployment rate has steadily been rising despite a slight dip in December to 6.7%. According to Stats Can, unemployment is still elevated. So again, practically what I've been saying here all along. So TD is looking to sell its stake in Schwab, and it's basically, the analysts are saying the reason why they might do it is to buy their own stock. So obviously they've been hit with these massive fines, and that basically obviously does affect TD because these fines have been absolutely huge, as we'll get into in a minute. And another fine that came out recently is BMO. So BMO has been hit with a US $40 million fine, and basically it's based on supervision failures to do with mortgage bonds. So get a load of this because it shows what the Canadian banks could be doing in Canada. So the SEC says BMO has agreed to pay more than $40 million to settle charges related to the bank's alleged supervision failure in bond selling. The regulator said Monday the apparent lack of oversight allowed employees in the BMO Capital Markets division to allegedly sell residential mortgage-backed bonds using misleading metrics. According to the SEC order, adding a small amount of higher interest paying mortgages to the backing pool would distort how the collateral was reported by third-party data providers, basically making the bonds look more attractive and better than they actually were. So it's like putting a facade in front of that bond to make it look better that you have these really good mortgages, essentially. It says adding just $1,000 worth of higher interest paying mortgages to millions of dollars of lower paying mortgages would make it seem like the bond was backed by a large amount of the more attractive higher interest rate mortgages. So again, basically just messing around with mortgage-backed securities and mortgage bonds. And this is the Canadian bank, and this is what's literally happening in 2025, and they've just been fined for doing it. So again, this is so similar, eerily similar to what happened in 2008. And another thing that is eerily similar to what happened in 2008 is Germany records highest company bankruptcies since financial crisis. So obviously the biggest economy in Europe, recording the most companies going bankrupt. And it's a global economy at the end of the day. So you have to look at this and think, well, it's going to affect everywhere. The Germans have a big manufacturing base. Germany recorded the highest number of company insolvencies since 2009 in the last quarter of last year, reflecting high interest rates and increased prices. They forgot to mention deteriorating economy as well. The fourth quarter of 2024 saw 4,215 company insolvencies with almost 38,000 jobs affected, according to the study, a level unseen since the financial crisis in mid-2009. And obviously, if demand is going down, if we're heading into recession, you're going to have places like Germany that are going to be impacted by this because they're manufacturing so much of the goods. Obviously, one of the biggest manufacturers, if not the biggest manufacturer in Europe. So obviously what's happening there, and also what's going on with BMO and what's happening with TD, it doesn't really make you feel that great about the Canadian banks. And obviously on the top of that, you've got to think about the consumer. You know, so many of the consumers are insolvent right now, and the banks know it. They're trying to work with them. So it's just a case of when is rubber gonna meet the road, and that's what we're gonna have to continue to monitor here on the channel. So anyway, if you've enjoyed this video, I'd highly recommend that you check out this video here. If you want early access to exclusive content and want to help support the channel, then please go to buymeacoffee.com/marketmania. If you want to help support the channel and get the best VPN, go to expressvpn.com/marketmania. Thank you, and I will see you in the next